remember that trading, we mentioned that trading is really much a process that produces an outcome, and it requires you to get onto a journey. Now you can play trading at different levels by following someone else trade signals, or taking a responsibility and learning skills to understand how price really moves. So these 10 steps are about how to become successful, and you will remember that again, it's a process. We want to get from where we are now to where we're gonna want to be, and in order to do that, we need to change our beliefs, behaviors, and routines as well. Now, a lot of difficulties traders, new and experienced traders, have is that in the years they have created beliefs about how the market works that are wrong, that are not grounded in the way modern market works. So that's one of the problems. You also mentioned that we have to treat trading as a business, not as a way to, now it's not as a substitute of a job, because it is not. Of course, it can generate a constant flow, but in average, that flow will be constant. Sometimes there will be less opportunities, sometimes there will be more opportunities. So a lot of people fail because they fail to learn skills that will serve for life, while they are only looking for quick bucks. And that's, if you have that mindset, you want to be successful in trading, you have to change that mindset. Well, that will make you one of the 95% of traders that lose consistently because they never learn skills. So, as we mentioned, understanding risk and reality of trading, the mechanics of value trading edge. And today, we're going to talk about the execution of a simple trading plan. Now, this may be something very, very simple, but the reality is that a lot of people, the majority of people, when put in front of a simple trading plan, and I'll give you an example later on, they're not capable of following it. Okay, so if you lack the discipline or of following a simple trading plan, then definitely trading is not for you, because even if you don't want to develop a full understanding of how market works, and you just want to stop here at the 5th step that can make you still profitable and very, very profitable in trading, you need to learn how to execute simple trading plans. So this is very, very important. So how do we stick to the plan? And why we need a plan. Now, executing a trading plan is simple, but not easy. It's not easy because a lot of people can just not discipline themselves to enter only at the right price, to put the stop only where the stop is being suggested, and to execute the plan as it was initially thought. Now, a problem that a lot of people have is also that they don't understand risk and money management. So lots of traders trade fixed lots. Now, when you trade a fixed lot, and we looked at that also when we spoke about risk management. When you trade a fixed lot, let's say you trade one lot, right? And you're trading futures, and that translates in a variable pip risk, because sometimes that one lot will correspond to 10 pips, and other times it correspond to 100 pips. So the the problem is that it is important to know where what the pip risk is, because that's what specifies and defines your maximum loss. So if your pip risk is 100, then, and you always play one lot, obviously, you're going to lose 1,000 depending or more, depending on which pair you are trading. If your pip risk is 10, your loss is 100. So as you can see here, the dollar loss, the dollar risk, it's not fixed, but it's variable, and we don't want that, because if you're let's say if your 1% of your account it's $100, in one case you're risking 1%, in another case you're risking a very, very high 10%. And that's something that absolutely you have to avoid. So one of the problems that I have noted by working with lots of traders and students and also subscribers to the trading signal is that they do not execute the plan properly, and they do not accept a small risk. And unfortunately, they also do not accept a large risk sometimes, because if they trade a fixed lot, let's say one lot, and they risk $1,000 on that account, let's say 10% on a 10K account, what happens is that if they don't accept that large risk, they're in trouble as well, because if they never contemplated the fact that they can lose 10% on their account, they will not act and exit when their stop loss is it. So as you can see, and we spoke about this also in step 2, accepting risk is very, very important. Now, I like what Alexander Elder said and wrote, every clown can put up a trade. Of course, Alexander Elder was making reference to identifying a setup, but this applies to simple trading plan execution. So obviously entering with a limit or stop market order is not complicated. What is complicated is entering exactly at the prices that are suggested in a trading plan, because if you do that, and obviously you calculate your position properly, then you know that you're limiting your risk to that limit that you set. And my limit is 1%, and I'll explain in step 5 why even a small risk like 1% on each trade can lead to very good results when we leverage our results using money management. That's something for step 5. And also because we reach objectives in trading with money management, and we will talk about this next week. So basically, the mechanics of trading, entering and exiting, is not complicated, and there are a lot of tools that can help you doing that, CTrader or add-ons to MT4. And of course, if you're trading using other platforms, TradeStation, CMC, and so on, you have that capability built into your platform. So why sticking to a trading plan is not easy? So what's the problem there? Well, the main problems are lack of confidence, not acceptance of risk, and we spoke about accepting small risk and accepting large risk. The reason why small risk is not accepted because people say, well, I have to put a lot of work into it, and I'm gonna only risking 1% of my account. But they don't understand the importance of money management and the fact that we reach objectives through money management. Other problems that get in the way are ego. I know it already. I don't agree. I know better. I don't take this trade because I know better. I think this is not a good trade, and sometimes so ego comes into the picture if you have to take a trade. And the problem is that whenever you have a trading edge, and we spoke about this in step 3, if you don't take all the trades, you're not able to actually reach the statistics and reach the objectives and statistics of the trading edge. So you're not able, if you don't trade all the opportunity, you may miss the opportunity that actually provides you 3 units of risk in return or 5 units of risk. So if you are selective and you just let your ego or lack of confidence and acceptance for risk, which should not be a problem if you're able to position yourself properly, if you're able to calculate the position sizing, then you will not be able to reach the expectancy of a trading system. All right, so you need a leap of faith if you don't understand the method that is behind the recommendation that you're asked to trade. And that's again another reason why you should always attempt to build skills. And this is a business after all. So if you want to go for the long haul, if you're in for a long haul, you're not going to execute someone else's signals forever. And you're not going to get rich in 1 year. So if you really choose trading to be a business, to be something that you want to do, then you need to build skills. And the problem of piggybacking someone else is that once that someone else is gone, you're left without anything. So the mechanism of order entry and management will not stop. In fact, they're very simple, and that's typically not what stops people. What stops people is that they take too high of risks. They do not understand risk and money management. And even when they lose money, actually, they get back into the game. The problem is that if you get back into the game and you have not built skills, then you are doomed to repeat the same mistakes. So overconfidence, of course, will stop you, and that's perfectly obvious, because you have to build some kind of confidence in what you are actually trading. So, what is the solution? Well, what we should do? Well, if you decide to go for the long haul, if you're in for the long haul, then you need to take lower risk trades. You have to paper trades. You have to study past results for the services that give you the past performance, and give yourself time to understand how you function as well with that method. And you can also enroll in a coaching program, particularly, there are many of them. I offer the FibStalker Methods coaching program to build those skills. So again, we had, so we reviewed these points here: lack of confidence and acceptance of risk, ego, and this can get into the in the way. Now, when we look at the trading plan has the following components. There are 8 components there. Some others say there are 10, but then we enter into multiple trading systems, as well as asset allocation, deciding how much we dedicate to each market. But there are at least the following parts, and this can be further reduced here. But whenever you want to trade, you have to, of course, to decide which market you're going to trade, and maybe why. The setup, which is the setup is really a series of rules, analysis criteria to take action, and that can also give you the direction, long or short. The entry, it's really a level. The entry should be very, very simple. It is just a level, and there has to be a simple concept around how to get involved. When price gets to that level, if it's a limit order, then you get in. But whenever the price goes through that level long in the direction of the trade, that's a market stop and entry, and that's the way you get in. So the entry should be really a price level and just a basic mechanism how you're going to enter it. And then there's another price level, which is the stop loss, which tells you which price level the market has proven you wrong, and that's very, very important. There are some re-entry criteria. Some of the systems can have re-entry criteria. I don't use re-entry criteria when I'm stopped out from a setup. I actually reevaluate the market and basically come up with a different or a similar setup, but after complete analysis to see what has changed. It can be exits or partial exits. I have 3 different types of exit: the risk-free level, the target number 1 and target number 2. And of course, there is, if you use partial exit, there is also a level, which is the level where you take out the position and when you complete the trade. And finally, position sizing, that can be calculated very simply if you use a percentage fraction of your account, and you should be doing that and leave the bad practice of virtually trading full lots. Okay, so these are the components. Now there is a minimum number of components if we take out some of the components here which are not really needed. The re-entry, the position size, which is implied by the pip risk, which is the distance between the entry and stop. What you get is something much more simplified here, and this is typical trading plan I'll give in my trading signal service. And as you can see, there is an entry below, which is 1 pip below the level, the stop above 1 pip above the level. And if you want to get more sophisticated, you can use the average. You can use an average value which is different depending on what market you are trading here. And there is a risk-free level, and risk-free, if you remember, we spoke about this, is basically the level where I will remove half of the position, and this gives us the opportunity to keep riding half of the remaining position, the half remaining position. But if we are stopped out, we are stopped at break-even plus cost of trade. And then there is typically one or more target. In this case, there is one target. For each trade, I will calculate the reward to risk without using the risk-free level, and the adjusted reward to risk. It's basically the reward to risk when we exit only half of the position. And the adjusted reward to risk, it's very simply calculated with a formula that takes into consideration the normal reward to risk if you would not exit half of the position at the risk-free level, plus 1, and the sum is divided by 2. And that's the way we calculate this adjusted reward risk, which is obviously lower than the reward risk that you would get in the full trade. But there are reasons, several reasons to use an adjusted reward risk and using a technique that exit half of the position at the risk-free level. All right, so